Hello, hello. Here is me again. Okay, so our next talk, this one also is exciting. All talks are exciting. So this one is about the death of passive yield, why DeFi needs real work. So as AI and robotics reshape the world, their compute power can anchor a new kind of a productive finance where on-chain returns and build next generation of trading. There you go. Yes, yes, yes. Sorry, I was testing if you're paying attention. Apparently you did. Okay, so next generation of trading, how markets evolve. Now we have Simran Singh from Monaco Research. We have Katie from Arca, and we have Peter from JPEG Trading. Come on. Thanks for the correction and paying attention to my talk.
All right, all right. Test. Okay, yeah, you kind of hear me. All right, well, I wasn't important enough to get a intro, but my name is Kelvin Sparks. I'm a researcher and podcast host at The Block. I'll be moderating this discussion and GM in the PM, everyone. So maybe to start out, we'll have our guests go along the line and introduce yourselves. Then we'll get into it.
I will say it's the first time. Is my mic on?
Yeah, it's on.
All right, cool. It's the first time I've ever heard anyone say GM and PM, so I respect that. I like that a
Coin
lot. Yeah, turn it into a token. Tokenize everything. It's great to meet everyone. My name is Peter. I'm from JPEG Trading, where I am a partner currently. You might have seen our logo around this week. We're trying to make a good old push on that side of things. But long story short, JPEG Trading, we're a prop trading desk and a research firm. So we do a lot of prop trading, as obviously. We do a lot of token market making things as well, a lot of engagements directly with different venues, whether they be on or off chain. I spend a lot of time doing, allocating to DVL deals, venture investing, just wake up and try to find interesting opportunities to trade and invest in and make some money. But that's us.
Hello, everyone. Simran Singh, CEO of Monaco Research. Monaco is building a global trading network that takes compliance first, because in a world where you have to choose one or the other, it's the compliant answer that inevitably wins long term. We're marketing this as very much the last trading exchange that you'll ever need.
Hello, I'm Katie Talati. I'm the Director of Research at Arca. We're a crypto-native asset manager. We've been around since 2018, and we have a family of 3 funds that I oversee the investment research for. And our flagship fund is a liquid token fund, so very familiar with the token trading space.
Nice. So without further ado, let's get into it. I think, Simran, you and I were having a very interesting conversation last night on price execution. I mean, right now it seems like MEV, market making, and even validators are all starting to converge and fight for the same resources while also trying to get users the best prices. So could you speak to some of the work that you're doing in that area, as well as where you think things are headed?
Sure. I think people throw around the word liquidity fragmentation a lot. What that really just means is the 0 to 1 of crypto was self-custody, and then people went out and made 4,000 versions of the same thing. And so then if you have to keep the price of ETH on chain 1 versus chain 2 together, there needs to be something that brings those together. And I think the way that you do that is by having an overarching network that is able to solve the best price for you. And so you have developments like CowSwap or any, honestly, RFQ platform that's developed, which serves as a meta aggregator. The conversation that we were having last night was more geared towards prop AMMs, which are this innovation which, dare I say, combine off-chain matching elements with on-chain settlement, which I strongly believe is probably the inevitable asymptotic conclusion for how execution is going to be managed. If you limit things to be fully on-chain, we know for a fact that this is not nearly performant enough when you're talking about actual HFT. Retail may not necessarily care about, do I pay an additional 2 bips or not, but when you're talking about billions and billions of dollars of assets flowing, if not trillions, those additional bips add up, and so execution actually matters.
Absolutely. And with that, you're talking about execution. This is respect to products that people want to trade. We saw a Cambrian explosion in HIP3 perps volume. This is on hyperliquid derivatives contracts that really captured the hearts and minds. It felt like all of crypto for a few months. One of the things that I thought was interesting was precious metals coming on chain, and with that, silver. During that massive, nasty drawdown, I think Hyperliquid captured about 2% of open interest on that day. Katie, I see you nodding. I'm going to pass it over to you. Like, do you think perps will ever be a product that is going to be widely used by retail?
I mean, I think you're already kind of seeing that, and you're seeing that interest there because you essentially can use perps on pretty much any product that's out there. And you're seeing the adoption in TradFi as well, which I think kind of legitimizes it. I will say, though, I think for kind of that mass retail adoption audience, it kind of has to be treated like options, because you hear again and again, right? So many like people are like, oh my God, I liquidated my whole portfolio because I was like trading, well, first years ago it was on BitMEX, and then it's on Binance, and now it's on Hyperliquid. But it's the same story, which is like really like unfortunately, we shouldn't give like everybody the same access to each financial instrument. Like, you should have some base knowledge of like how portfolio margin works, and like, you know, what does it mean to take on like 2, 3, 10x leverage, dare say 100x, and like how that can essentially like liquidate your assets, because it ends in a lot of like sob stories, unfortunately. But it is a really great method of essentially, you know, making more capital efficiency out of what you have if you know how to do it the right way and if you can bear the risk.
Very eloquently stated. Pete, oh, did you want to add something?
Oh, yeah, sure, I guess. No, I think that's a great point. And I know you briefly bring up kind of the education aspect of how to kind of get retail users to really be prolific around perps trading. And I'm not convinced yet that we will ever kind of get to that point. And I also do think that like crypto education and onboarding, all of that's an entirely other conversation. But I guess I bring up the mic just to kind of underscore the importance of perps markets being developed and being matured over the years in crypto. I think we kind of woke up overnight, and it kind of almost became natural course of action, right? There's a spot market, eventually it matures and there becomes a perps market. There's always that volume flow there. But I think it's gotten to a point where we really kind of have maybe forgotten about the just genuine trading benefits perps markets have brought to crypto, and having it take a life form that is a little bit more sophisticated and institutionalized, right? Where like back a couple years ago, spot was really the signal, but you really only have a portion of the picture because it doesn't tell the whole story. Now you kind of have perps where you are able to do a bunch of more sophisticated strategies and things along that line. So the growth of perps has been tremendous for, you know, sophisticated trading shops, but not only just for us, for those who are really kind of gearing up into more derivative tradings or other more, you know, I guess high level strategies rather than just long in spot.
Peter, I was going to ask you though, because like one thing, and this just popped in my head, like I do think we've seen more now though when the perps market outpaces spot by so much volume that you do start to see more manipulation, because it's easier to manipulate those perps markets and then therefore manipulate the underlying spot, because it can make it look like somebody's buying spot when in fact they're not.
Yeah, to that, honestly, in my mind, right, it's kind of growth stages is kind of how I see it, right? Like when we're talking about something incredibly nascent, like derivative markets and the function of that aren't particularly new by any means, but kind of introducing perpetual futures into crypto, like, yeah, it's been, you know, growing over the years, and I think that it's just a natural course of correction that does need to take place. There's going to be kind of a byproduct of market manipulation or other kind of market events or kind of things that people can do to not have the cleanest trading activity, but that's partially, I think, a responsibility of A, at the protocol level, B, if it's a centralized venue, then partially in the centralized venue as well, but also a couple of like, I suppose, market dynamics that could be set into place to kind of cover those things that you're describing. But yeah, I see it more as a byproduct now more than anything else. I think on a net basis, it's done definitely net good rather than harm, but yeah.
I was just going to add, I think the development of perp volume and the fact that it's seen such a surge compared to spot is a byproduct purely of market microstructure, right? You have dated futures that exist in traditional finance because the actual original use case for futures was to hedge. Right, there was an actual physical spot thing that you were hedging. My background is in oil trading at Goldman, and it's like you can actually smell a barrel of oil and go down to Cushing, Oklahoma, and see it. And so if you want to hedge against the price of that, you probably want to sell a WTI contract to lock in a price if you're an oil producer, or if you're an airline, you want to hedge on fuel costs, right? And so when you approach it from that perspective, there's an actual reason to drive this mechanic, versus in crypto, we know that in an era of hyper-financialization, all I really care about is cheap access to directional leverage, which is also why you haven't really seen the emergence of liquid altcoin options markets, right? And so I think like it very much is easy to manipulate the underlying Oracle price because there isn't something to peg it to, because the demand is very much more for speculation than hedging.
Well said. Well said. And one of the things I was curious about now with respect to new kinds of structured products, we're seeing a lot of these CDFI vaults start to pop up. One of which that's notable is Chaos Labs launched one recently with Kraken. So as folks are looking for these strategies, they want to earn high yields. How do you think about mitigating that risk for maybe an incumbent who's coming into crypto, doesn't really know much, and doesn't really know how to underwrite smart contract risk? What would you say to these institutions who are curious but don't necessarily know where to start in DeFi trading?
I mean, so it's funny you say this. I actually wrote a piece about this like 3 weeks ago.
Oh, perfect.
Every form of yield in crypto, and I'm generalizing here, but it's actually quite true. Every form of yield in crypto is one of four things. The probably most real form of yield is RWAs, right? I'm tokenizing treasuries. I'm being charged illiquidity premium if I'm tokenizing private credit. There's an actual fundamental cash flow that's driving that yield. That is one form of yield. The second form of yield is levered looping or funding trades, right? There's a dislocation. People want access to leverage. I'm getting compensated by collecting funding by going the other side of the trade, by providing access to that leverage, or it's running levered looping strategies on Morpho Nave. The third bucket is selling some sort of options, right? So when people talk about structured products in crypto, I always have to stop myself from chuckling because structured products in crypto is trying to like put a Ferrari engine in a horse car, right? It's like structured products in TradFi are corridor variants, like things that sound like Greek to everyone, including myself, very much because the underlying market is liquid and there's actual primitives that you can use to hedge. Structured products in crypto means selling optionality as a yield product. Right? And so that's the third form of yield. And the fourth form of yield, which I actually don't include as yield, but often gets bucketed, is inflationary dynamics, right? Which is like VC-based incentive. I'm trying to bootstrap liquidity. Let me throw money your way and lock in TVL deals. And so if someone is entering into the DeFi landscape, I would argue that if they're trying to optimize for yield, they need to understand like yield comes from being compensated for taking risk. These are the basic primitives and building blocks of that risk, and then you have to choose, does this make sense? Is this a long-term sustainable thing? Or is the 30% that I'm getting from Anchor probably Fugazi, Tsawazi, Tsawuzi?
There's no free lunch.
Yeah, I mean, straight up, you guys are hit it on the head. Like, money does not grow on trees. Any type of a stable coin, LP deal, whatever it might be, a vault, CD5 vaults, whatever. Like, anytime yield is mentioned, it's being derived from something, right? And I think oftentimes people just forget to ask the right questions. And even if it's not even talking about the yield generation aspect of it, but let's talk about the settlement side of it too, right? Like, what are you receiving what are you receiving the yield in? How is it settled? What are the controls around these assets, right? Like, so there's a lot of due diligence questions that admittedly are very difficult for non-crypto friendly people to know even fundamentally that they have to ask. So it's a challenge, but I don't know. You've got the guy who wrote the paper on it here. So.
Well, I mean, crypto's still everything you don't know about money combined with everything you don't know about computers, but we are getting better over time. Yeah, exactly.
Well said.
Well, one thing I kind of want to move on now to is talk about these trading venues. If you look at what's going on, the wars between centralized exchanges and decentralized exchanges, as well as the different products that are offering there. Maybe, Katie, this could be an interesting one for you. How do you see this playing out, as it seems like they're almost fighting for market share at some level?
Yeah, I mean, my original thesis, and this was like years and years ago, but, we definitely saw people are distrustful of centralized exchanges. And that's just because of the nature of, you're having them custody your assets. And so over time, and I know people who've been in the space far longer than me, they lost money in the Bitfinex hack. They lost money in, get BitGo or any of these other, places that were supposed to be safe. And everyone says, not your keys, not your crypto, right? So it made sense to when Uniswap launched, that we saw kind of this move towards the decentralized exchange because people could have, assets in their own custody. But the trade-off is that at the end of the day, an AMM is not the same as an order book. And in order to kind of have that order book technology, you can't really decentralize it because it introduces a ton of problems with things like front running, sandwich attacks, et cetera. I mean, we could go into each of these in depth, but the problem with that is that I still think you see people then gravitate towards the CDFI products, right? Or the places that are decentralized-ish, right? So you have things like Hyperliquid, where it's a closed validator set, so they can offer the order book product. There is still some front running, though, that happens, as we know. So I think that people want to go to the totally decentralized route. I don't know if it's going to be possible unless we have far superior technology introduced, especially on the privacy side.
Oh, that's an interesting point you made. And one of the call outs you said with respect to MEV. If you don't know who Jared from Subway.eth is, look him up. He's a sandwich attacker. He's alive and very, very well. The Mev bots still do work. But I digress. But we don't have that much time left. So with 8 minutes and 30 seconds, Peter, I'm kind of curious, like AI, how is that going to change how we think about financial markets and trading?
I say D, all the above. No, I mean it's a massive umbrella topic, and the beautiful thing about it is I think that we've only really begun to scratch the surface around these things, right? Like we're thinking about the most simple applications of decision making, of effectively just efficiency, and like those kind of very general problems that we face every day in financial decision making, and tossing AI or a chunk of code at the problem and saying, think about this for me, solve it for me, now rinse and repeat the problem. The answer to your question, I don't know. That's
What
my
are you curious
honest take
about
on it.
then?
What's that?
What are you curious about then with respect to what you can do with AI and on-chain finance or transactions?
Yeah, the things that are really interesting to me are obviously the agentic stuff that are going on. There's this project called Giza. They're still around and they're doing pretty well, but they're pretty early on into the agentic game, right? They're effectively building agents that you can teach it very, very specifically the trading strategies you want it to follow, and it self executes itself across multiple chains. It's very interesting stuff. I think for us, like when I think about kind of AI and how it's going to be used in, I guess, my day-to-day life and the firm's day-to-day life, I just look at our day like a pie, right? And like think about where I'm spending time. And if AI can come in and ease some of the operational side of those things, that's exciting for us, right? And then we start to think about like this on a long-term scale over a period of a month or a year, how much time is this saving? And if it gets to a point where in which the dollar, it's like the brain cells spent, or yes, the brain cells spent per dollar earned is leaning towards, not being worth it, then that's an application that we're not going to use. Effectively, what I'm trying to say here is that there are things and applications in which AI is really good for, specifically in trading crypto and trading on DeFi scenes. But I think there are a lot of things that are just oversaturated, and honestly, we're trying to solve a problem that doesn't really exist yet. So I'm on the side of trying to wait to see what the true applications, the powerful things are going to be on. But we've invested into a couple of different people, Giza specifically, that we really do find interesting. So I'm down to really kind of explore and observe how this agentic AI stuff develops specifically for DeFi applications over the next 6 months, or 6 to 12 months.
Understood. Better than me. Usually I say, Claude, make me $1 billion, make no mistakes.
I use it every day too. It like scans my Telegram stuff and my Slack channels. But yeah, for DeFi trading applications, I think it's the most interesting and most native use case that we probably have for it. But then you start to call into other themes and schools of thoughts like, hey, vulnerability, risk, and all these types of things that
Oh, agreed. These things still definitely do need guardrails. And with that, you don't want to get prompt inject or any weird type of hallucinations, things of that nature. But it is fascinating with small amounts of capital, not financial advice, do your own research, and all the other disclosures. But that being said, I think someone touched on privacy earlier. What role does privacy play in DeFi?
I mean, a ton. I mean, right now, I think probably one of the biggest gating factors for institutions to really adopt, some of the DeFi primitives that we have, whether it's trading on chain, using lend borrow protocols, even using stable coins for payments, is that everyone can see what's going on and how much you're sending and who it's going to. And even though it's, pseudo-anonymous, you're sending it to a wallet, you don't necessarily know the owner, there's a lot of people who've been doxxed these days. So you can figure out, who owns it, especially if they're using an ENS.eth address. And so I do think that, privacy has to be on the roadmap for any of the major L1s, for any of these kind of like major products. That said, it is really like a hard thing to institute. I think there's some like really great work going on some of the L2s. I think that, we've seen like a lot of projects are trying to really make, privacy this novel thing. But kind of like all technology in this space, there's, we get 2 steps forward, but there's at least 1 step back in terms of like there's always a trade-off. And so I do think like privacy will, you will need to get that. I think unfortunately that's why we're starting to see the rise of some of the more like enterprise chains that have come out in the last year or two, because they need that like opt-in privacy feature for their users. And so I think it'll be really interesting to see in the next few years, like can Ethereum, like come back and capture some of that, or is it going to be like layer 2s that are really specific for these, trading instances? I think it's question with no answer just yet.
Yeah, understood. So maybe then to get even more meta, predictions of the future are oftentimes wrong, and predictions about technology in the future are oftentimes even further off. But think about like a dark pool volume versus spot volume, retail and crypto. Which do you see being the dominant in maybe 2 years' time?
You said dark pool volume versus spot volume?
Yes.
Oh, by far dark pool volume, right? I mean,
Yeah, that would mean the institutions are here.
yeah, I mean, yeah, I would hope so. If you look at the U.S. equity market as a proxy, right, I think 55% on average of U.S. equity volume that is traded is actually off exchange, right? And so in the context of privacy, that becomes super important. Whenever I first hear privacy, I actually always think about two things. One is when, if you go on crypto Twitter, you hear people like, oh, market maker so-and-so X moved, these funds from A to B or put on this position. And I'm just like, did you ever think that you were only seeing one side of the equation? Like maybe it's a delta neutral trade, right? And so, or even in TradFi, right? When people talk about, look at CME open interest, like institutions have never been shorter BTC futures. And it's like, well, what is the actual implied basis? Maybe they're just putting on a basis trade, or like ETF inflows are seeing massive, right? It's the same thing. So if you're only seeing one side of if only one side of the equation is transparent, I think it leads to one, just like the wrong signals or wrong narratives. So that is one reason why this is important. The other reason I think it becomes important is whenever you have massive flows, right? Think about index rebalancing. Billions and billions of dollars is being rebalanced on a very consistent basis. And if you can front run that flow, if I know the largest asset manager in the world is about to buy it, right, that's a pretty clear signal. So privacy remains a very top of turban consideration. And so you have things like Zama and Phoenix, fully homeomorphic encryption, that are trying to solve this. The challenge becomes when you have cryptographic complexity with a requirement for low latency, that is a non-trivial problem. Right? You could either be like very, very encrypted, but then you have fragmented liquidity because you have confidential tokens, right? And so you have to meet that standard and a lot of latency. Or you have high performance systems that are operating on the order of like single digit millis, if not like 13.9 nanosecond tick to trades, but then like it's going to be very non-confidential.
Understood. And I only have about 2 minutes left of these GigaBrains times. So I'd be curious to ask, what are you most interested in or want to spend more time exploring with respect to the future of trading these days?
I mean, the obvious answer for me, at least, is like, how do we see traditional markets come more on chain, and more so along the lines of tokenization? I do think that we have a lot of assets in the space, but there's a lot of things like meme coins, which, like, at least for me as a fundamental investor, there's not really a place for that in my portfolio. But buying tokenized stocks, buying actual tokenized real commodities, like that is kind of the future we're headed towards, and so that I'm excited for. But it's not coming this year. It's going to be many years of slow progress on that one.
Yeah, I'm excited to continue observing the race between CeFi and DeFi parties at play, right? And the CDeFi thing. I think it was talked about earlier where we, take one step forward or 2 steps backwards and things like that. I think very indicative in crypto specifically. You asked about AI earlier, right? And we talk about privacy, or we talk about the battle between CDeFi, right? We're always doing this thing where we see something cool, we see something innovative, and there's a billion people trying to put a different wrapper on it, make a different type of version of it, and we start to overcomplicate a problem that started off as relatively simple. So I think in my mind this year there's going to be a lot of variance in flow between decentralized centralized venues and DeFi venues and stuff. We saw the wave of perp dexes being exploded on last year and everything. I'm interested to see and observe like which ones die out this year, quite frankly speaking, which ones survive, and the mechanics of which they do live on by. And I think there's going to be a lot of signaling as to what those things are. I'm excited to watch you guys grow as well at Monaco. And so I think those things are the things that are really going to be interesting to watch, especially in the market environment that we are in, right? Like liquidity is not as, easy to come by from allocators or things of that nature as it maybe was 6 months ago. So yeah, just interested to see how the money dries up, where it travels to, how it's traded, and if it really does start to shift in DeFi's favor, or in this time of consolidation, we do see CeFi powers coming to play a little bit more prevalently.
Simran, we got like 15 seconds.
Sorry, brother.
Last take.
Tokenization taking over the world.
Mic drop. There you have it. Thank you for attending, folks. I hope you enjoyed the talk. Cheers.
Thanks, man.